All right, welcome back to the DeFi House, and in this video I want to show you how do you find the ranges, how do you set the ranges on smaller assets that are not widely available. Maybe they don't have enough market history, chart history, and you're not able to use the bullseye borders that I just showed you before. So in that case, you want to use basically common sense, right? And this method also applies to all the assets. And to be totally honest, in most cases, I do use this simple common sense rather than setting specific ranges using certain indicators like bullseye borders. So let me show you this common sense method, right? Which is nothing spectacular, and it's purely based on where the market is and what kind of goal you have for this market. So you always have to remember that when you are setting the range, right, you are basically entering in both sides. And if you set the equal range, meaning that, for example, let me get the rectangle tool, and let's say that you set the range from the current price that much, and then you want to copy and paste, and from the lower side that much, which is equal range. So in this case we set the range about 23% up and about a 23% down. In that case, your deposit ratio will always be 50-50. But if you set the range differently, let's say that you set the range from the current price. Let me get the rectangle tool. Maybe from the current price, you want to set the range like that. Okay, meaning that you leave less space to the downside and more space to the upside, right? So if you set a range like that, then your deposit ratio will always vary. And in this case, if this is Giza USDC pool, so the first asset is Giza and second one is USDC, then if you leave less space to the downside and more space to the upside, you will be depositing most of the money in Giza coins and just a bit in USDC. And then as the price of the Giza coin goes up, you will be slowly converted into the USDC. And eventually, if the price continuously going up, and eventually breaks your range from the upside, you will be converted fully to USDC. The same applies vice versa. If, for example, you set your range like that, you leave just a bit space to the upper side. Maybe let's do it like that, and most of the range is lower, right? So then your deposit ratio will also vary and be mostly in USDC. And as the price of Giza goes down, you stay in range, you earn the fees, but you are also slowly being converted into Giza more and more. Eventually, if the price reaches the lowest point of your range and maybe even breaks it below, you are 100% converted to Giza coins. So you have to basically keep this in mind as well, because this is an important element, right? So as I said, you need to ask yourself two questions: where the market is, so what kind of movement is more likely? If the market is at all-time highs, you definitely don't want to be giving too much upper range and just a bit lower range, because the market is already at all-time highs, meaning that there is a higher probability that in the nearest time you will see a pullback lower rather than a massive continuation to the upside, right? And in this case, if the market is at the all-time highs and you set the range like that, well, you will be depositing mostly in Giza, right? And as Giza rises, you're being slowly converted into USDC. But if the Giza coin and the market itself is at all-time highs, and the probability of a pullback is much higher than continuation upside, then basically you will be out of this range very quickly if the Giza coin or market in general starts to move lower. And right here, let's say exactly that happens and Giza just drops like 5 or 4%, which is nothing for such a small volatile asset, and you are already out of range, fully converted just to Giza coins, you are not earning the fees, right? And if Giza and market continuously drops, you are even losing due to the impermanent loss because you are fully converted to Giza. Giza is going down, so your initial value is also going down. And it's not always a bad thing, but I'm gonna explain this in the next lesson. But for now, you wanna ask yourself, where is the market and what is your goal? And if the market is at the all-time highs or aggressively moving higher and you expect the market to pull back in the nearest future, is best to give the range just a bit space to the upside and give most of the range to the downside, meaning that even if the market starts to pull back and starts to drop, yes, of course, your initial deposit amount will go down in value because, well, one of the asset is going down, but the fees, you will be earning the fees way more active, way longer, because you will be in range for a longer period of time. And in most cases, you will be covered by the fees, even if market goes completely off the range. And of course, by knowing certain rebalancing strategies, how can you rebalance very easily, or how to hedge against market movements, the impermanent loss becomes a thing just to understand that this exists, but it's not gonna bother you. But it's always important because essentially when you are depositing into the range, you always think in such terms that, okay, I am actually buying some of these assets. So if you have only USDC in your wallet and you want to deploy capital into Giza USDC pool, and you know that Giza is very volatile, is a newer coin, as you can see, it's not that old, it's a fresh coin on base, for example, right? And you want to deploy capital into the LP because it pays amazing fees, that's one thing. Second thing is to understand that essentially you are gonna buy some Giza coins itself, because you always have to deploy capital into the pool in both sides, unless you use some of the methods that I'm gonna explain later on. They are a bit more advanced, but essentially to earn the fees, you have to be in the pool, and one way or another, you will have exposure to Giza. So you always have to remember that you are deploying capital to earn fees, all good, but you are also buying one of the assets, or both, if it's both a volatile, for example, Giza versus Ethereum and not USDC, then you have exposure to both volatile assets. So you always have to think in this matter as well. Are you happy? Are you comfortable buying some of the Giza right now? And if not, then you should actually reconsider your decision, because you will be in the pool, you will earn the fees, that's right, but worst case scenario, Giza starts to go down and you are getting converted more and more into Giza. And if you are not happy holding Giza for some period of time to recover the impermanent loss, or to stay in the pool for longer and gather the fees while Giza is down, etc., then you really have to think, do you actually need to enter into this pool? Maybe there are better pools or better assets that you want to enter, and you will be much more comfortable holding them for longer, right? Because sometimes it happens. Sometimes it happens that you enter into the pool, the volatile asset of the pool, let's say Giza USDC, goes down. You are out of range, you rebalance, you change the range using one of the advanced methods, so you know how to avoid buying back the coins with impermanent loss. It's all good, but essentially you are stuck in that pool for quite a while to recover everything and wait for the Giza to come back. And in some cases, it never happened to me yet, at least yet, but if you deploy capital to riskier assets, more volatile meme coins or utility coins that are low market cap, like this one is just 40 million, which is nothing in crypto market, it could happen that the coin can go down forever and eventually just die off. And you will not be able to generate enough fees, right? So throughout that time, you need to be as efficient as possible to get as much fees as possible, and always think, what would you do in a worst case scenario? And by that, you deploy as much capital as you're comfortable with. And I would never recommend deploying most of your capital into these volatile assets, riskier degen pools, so to speak, right? Because, for example, Sol USDC pool will never go to zero, right? Unless something extraordinary happens. And something like Giza USDC to go to zero, it's not that uncommon, right? So, and then basically setting the range. So you have this option to, first of all, identify where the market is, what is your goal, and whether you like to set the range more upper, more lower, or right in the middle or around the middle. So you know what kind of deposit ratio you will be allocating. And then setting the range itself, basically what you want to do is look at the market on a specific asset, in this case Giza, and go to the daily time frame. So one candle is 1 day, and essentially scan through the previous candlesticks and take a look at how much movement that candle generated. So if you hover on one of the candles, the previous one, on the upper side right here, you will see that, for example, it moved 13% yesterday. 2 days ago, it was almost 18%. Then we had 11%, 2%, 4%, 16%, 4%, 19%, 0.7%, 22%. And basically what you want to do is you want to scout through the historical candlesticks, daily candlesticks, and see how much in percentage that asset is moving pretty much in most of the days. So by scanning just this part of the chart, we can clearly see that in most of the days, it moves in between 15 to 17%. These smaller candlestick of 2%, 4%, 0.7% basically is not common, is not the majority of the days it's moving in such percentages. In most cases, recently at least, it is moving more than 9% and less than 20, I would say, right? More or less. So by setting your range, you keep this number in mind, and while setting the range, you basically calculate in a similar matter. So you have the current price, you know that in most cases it is moving between 10 to 15% per day. So you want to make the range now based on two factors. Do you want to be in range for as long as possible and manage the position as less as possible? In that case, you want to at least double the average daily movement for the range. So if you have, let's say, 10 to 15% daily average, you want to double it, at least maybe even triple it in some cases, to, let's say, 30 to 35, maybe to even 40%. And then based on your answers where the market is and what kind of range you are setting, more up, more down, or right in the middle, you want to set the range. So in this case, it could be something like 35%, let's say, just like that, from the current price, pretty equal. So it's going to be in total 34%. So the market can do whatever it wants within 35% range. Total range, you are going to be in range earning the fees. If you want to be more risky, so to speak, and earn more fees, but also be more active in terms of management the position. Do you want to monitor the position on a daily basis, on the maybe even hourly basis, maybe every few hours you have to check? Then you can use the exact number of the average or even lower. So if the average is between 10 to 15%, you want to use exactly that based from the current price. Maybe this could be something like that. Sorry, on a daily perspective, it does not look like much, right? Let's say 15%, more or less. But if you go to lower time frames, you will notice that within hourly, it stays in the range for quite a while, but do not expect to be in range for days or even weeks. It's more like up to a few days at most if market just starts to move sideways. But if the market is volatile, you will be in and out of range pretty often, and you will have to act accordingly, whether to wait for the market to come back or rebalance the pools, harvest the fees, and go again. So that's pretty much how you can set the ranges on these assets as well. You can use the bullseye borders method that I showed you previously, which is more technical, indicator based, and it works better on the blue chip assets, the biggest ones: Solana, Ethereum, Bitcoin, etc. And for the smaller coins, for all coins, the rest of the altcoins, you can definitely use this common sense method. Just measure up the average, what's happening in the market, determine what kind of range you are setting, and just set the range and have it that way. But to be honest, full honesty, I am mostly using this method that I'm showing you right now. Just common sense, right? That technical indicator is not too bad, but I noticed for me personally, it works better to use my own common sense and my own understanding where the market is. If you are a complete beginner, if you have no idea how to identify where the market is, what kind of cycle we are in, and whether we should continue up or start going down, or if we were going down, maybe we should start pulling back up or something. If you are not fully sure and you are a complete beginner, and you don't want to mess up with the ranges too much, then the best solution for you would be to simply use the bullseye borders, get comfortable using that, and by using that, you will be in the market, in DeFi, in pools, in ranges, and you will start noticing how the market moves, and eventually you will be able to use common sense method just to measure out the averages, set the range, leave it and forget, right? And earn the fees constantly. So this is the method. I like to call it common sense method. I'm not sure if it's the best name for this method, but it's basically common sense, right? You just look what the market is doing and act based on that information. So in my opinion, that's common sense. So hopefully it's now clear how to set the ranges and what to acknowledge before setting the range. And yeah, that's it for this lesson. And I will see you on a next one where I will be explaining different strategies for rebalancing the pool in a bit more advanced matter. So thank you, and I will see you on a next video.